Hey everyone, welcome back to another Stock Market Open live stream. Well, we've got, quite frankly, geopolitical issues that are becoming a lot worse. Posted a quick little update on eHack. We can get some more updates on there as well. But worst beige book of the cycle. Geopolitical issues are getting worse. Pakistan counterattacks militant groups after Iran starts militant groups in its country. That hasn't happened in like decades, so kind of weird how much tension is going is sort of boiling over. It's not even just growing tension anymore; it's just boiled over. Israel now reporting that Hamas is rebuilding its northern battalions, reorganizing in areas where Israel has already completed the work, so to speak. Red Sea strikes, frankly, worsening. Where now, it was a big deal when the United States first took its strikes against Yemen. We're now on the fourth round of strikes. So, yeah, those aren't getting as much coverage as the other strikes. But, yeah, we're on the fourth round of strikes. The Beige book it took me quite a while to get through all like 56 pages yesterday. But holy smokes, it's probably the most recessionary Beige book we have. So the stock market doesn't seem to care, though, because the stock market probably cheers it on. Frankly, you got, look at TSMC up 8%. Then at the same time, you've got a lot of various different stocks up. Part of that is not only, of course, due to some of the reports that we're getting, but also consider that if the market does or the economy does end up in recession, or maybe we're already in a recession, it'll likely boost Fed rate cuts pretty rapidly. And unfortunately, that doesn't help poorer individuals, but individuals who have relied on credit cards more, who have relied on buy now, pay later more, who have relied on basically debt financing. It's very difficult to start refinancing that if your income levels are restricted. So, and of course, I mean, there are ways to conduct debt consolidation, but my goodness, I mean, the rates on that, even at 0%, are very expensive because obviously debt consolidation loans won't be at 0%. So, yeah, unfortunate. It's going to be quite a bit of a challenging year. We'll see how it goes. But anyway, yeah, TSMC sees Q1 operating margin at a beat at about 41% versus the 39.4% that folks were looking for. They're looking at a gross margin of around 51.4%, which, frankly, for a manufacturer is crazy. I mean, we're talking like Microsoft level margins in chips here. It's absolutely phenomenal. They see this as a healthy growth year for them. In 2024, on a track to grow in the mid 20%. This is some big numbers for a company that's already pretty big. But has for sure a lot of folks pretty excited. So now the stock's up, to 111 over here in the pre-market. We'll see. Sometimes pre-market can be a little funny with how it operates. But then again, doesn't surprise me with that kind of margin on chip manufacturing. That's pretty exciting for the chips. So let's jump in over here for a moment. Let's see what they got. They got a lot of interviews going on over here. I know Jamie Dimon was up here yesterday. Who do they have today?
We haven't got that yet. So this is it's 1984. As far as
in a good way.
No, both ways.
In both ways. Okay.
In the good way.
What's the good way?
It's in the bad way, as you see it.
Well, it hasn't gotten bad as what social media.
This is all about AI and the future of creativity. People always have this funny tendency of just coming in here and like if you have a position, it's like they just want to remind you if your position's doing poorly. Like nobody ever wants to tell you if your position's doing good. But joke's on you, Michael. I already covered my Coinbase short. I did that during the trial yesterday and sent an alert to everybody in the structured psychology meeting. Joke's on you. So how bad is it doing? Profitable. Sorry, I had to do that. Okay, anyway. So Let's see. Okay, so let's find out. I want to see what's going on with bonds, and then we'll take a little bit more of a look at what else is going on. We know Apple's going to start reselling their watch again, but without the oxygen monitor. We've got the 10 years basically flat. It's stuck at 410. Then we've got... Let's see, what is this? Higher duration energy sectors are exposed to resurge. Yeah, I mean, everybody's worried about this idea of a resurgence of inflation. If you read the Beige book yesterday, frankly, the last thing that you think of after the Beige book yesterday is a resurgence in inflation. There's zero concern of a resurgence in inflation from the Beige book. I'll have to go through it in detail. I posted it on ehack.com, but yeah, there's zero concern, and that's rightfully so. That's not like people are blind to what's going on. It's a disaster. So taking a peek, I want to look one more time here, just make sure I got all the details here on TSM. So TSM again, we talked about how their Q4 gross margin. I want to see, is this just a one-time? So their gross margin in Q4 was 53%, beating the 52.9% estimate. But how does that compare to Q1? Wow, Q1 they expect it to be at a midpoint 53%. Yep, same number. That's wild. So let's see what the suits are saying here. Taiwan's semi outlook underscores how AI will be critical to a 2024 driver for chip industry where demand is still uneven. Profit at TSM, primary chip maker for NVIDIA and Apple, fell less than expected in Q4, and the chip maker projects a healthy growth year, giving it room to raise capital spending. Projecting sales growth of 20% per more as it captures a large slice of the AI chip demand. Yeah, I wonder how Intel's moving on that, because Intel's got to get into the manufacturing. We're supposed to bring the Intel plants online really this year to start getting, yeah, it's moving up 2%. And it's come down from about $52, but this could be a nice little catalyst to sort of push up on Intel again. You've got TSM. I mean, this will solidify the $100 mark, but not only that, we're past 107 here. Next stop, we have a tentative stop at like 110, but that's just a soft one that we've written in. So it could be kind of interesting if this could be the catalyst that pushes it out to 124. That's going to be one to watch. Here's Trade Desk. Look at this channel. I really suggest if you're a trader, you're probably going to want to look or keep an eye on this one. In fact, let's throw in an EMA here, mostly because I think you've got this potential for what's it called? You've got this potential for somewhere, hopefully, another support line. But then again, we've destroyed it on the fibs, and we're in this downtrend that's been going on for quite a while here. We've been moving on this downtrend for coming on 8 months now on Trade Desk. And we know when this down channel starts rotating back up, you get a pretty aggressive break. That doesn't mean it's going to hold, but you can get a pretty aggressive break. I mean, look at the aggressive break that Enphase had, but then gave up on, right? I mean, look at that. This was your aggressive breakout here once we confirmed the break, and it's sort of been fallen by the wayside a little bit since then. But you can get that breakout, these downtrends. So I like watching them. So let's see here. Then we have Bitcoin 42.3, Apple's up 2 today. It's interesting because Apple's been another one of those that got rejected by 200. Just been straight back down to a fib level here, and it's been dancing around that low 180s there for a moment. Okay, so let's see what else we have. So Yemen is a problem. I want to see the Telegraph had a good piece on them this morning. I was reading through some of their headlines. And then, of course, like you end up seeing that Kanye West, I guess, replaced all of his teeth with titanium. Yeah. So, okay, so we have, they got a picture of the ship that got struck. I'm going to pull that one up in a moment. But anyway, so we have Oh, let's see here. Oh, where is There it is. Pakistan. Pakistan has launched missiles at Iranian terror hideouts. Iranian state television said 3 women and 4 children had been killed in the attack. Pakistan said it respected Iran's sovereignty and territorial integrity, but it had taken action to protect and defend itself. A lot of pretty wild tensions right now that we haven't seen in quite a while. I mean, there has always been saber rattling, but boy, this just seems to be getting worse. Oh yeah, we do have jobless claims. Good call, Max. So jobless claims just came out. Jobless claims coming in at 187 versus the expectation of 205. Yeah, I'll tell you the problem with this is when the layoffs come, they come so fast and rapidly. These weekly jobless claims, I kind of think are a joke. Yeah, I mean, housing starts came in a little better than expected, 1.46 mil versus 1.425. Permits at 1.495 versus 1.477. Philly Fed outlook comes in at negative 10.6. The expectation was 6.5. But poof, the frank reality is jobless claims are not they're not a predictor of what's going on. Look at the nastiness of the Beige book, and you'll get enough of your predictor. It's pretty gross. So again, I threw a summary of that. Well, I mean, I have the highlighted version of it up. I still need to write the summary of it. I'll do that a little later. But anyway, that's at EHAC. Just crazy how ugly it is. I mean, there were sections where they're basically talking about, people can't afford cars anymore. Used cars, lower incomes can't. You've got wealthier individuals still spending freely, is the quote in there, but poorer individuals borrowing on debt, and the expectation is this will not last. And that's highly reasonable to understand. But beyond that, you have a lot of companies that are like, yeah, we're right-sizing our headcount, or we're keeping people because it's been hard to hire, but, if sales continue to decline, we could basically just start cutting rapidly. And that rapid cutting is the, that's the recessionary impetus. That's the biggest warning that you can get, is that businesses are basically lining up for that. Listen to him. He's always very animated.
Philly Fed minus 10.6. That means 5 minus months in a row, 5 negative signs in a row, and 12 of the last 13 months have been negative. Now, let's look at building housing starts for the month of December, 1,460,000. 1,460,000. That's a little bit better than we were looking for. And if you consider last month, it was 1,525,000. We could see that these numbers have dropped back down. Last month was an outlier. It was the best level on starts in 1.5 years, and we actually saw single family pop a bit. We know there's been a dearth of building, multifamily trying to make some of that up. In terms of permits, 1,495,000, and that follows 1,467,000. And that actually is a number, of course, that is a bit higher. It's up nearly 2%. Squawk Box will return after a short break.
Riley!
Yeah, wow. So, I'm just still looking at these TSM numbers. It's wild. I think what we also have to remember is, well, hold on a second here. That beat the, 39.4%. So, there we go. I think what we have to remember with TSM and quite frankly the AI chip sector is this is not a reflection of the economy. These stocks are a reflection of massive companies spending money that they indicating they do not want to be left behind. Right? That's what you have with AI spend. This the spend is driven solely, I'd say nearly solely, by cash-rich, massive companies not wanting to be left behind. Or basically not wanting to become irrelevant is the better way to put it. You know, basically my take is if you don't have an LLM, you know, a language learning model as part of your platform in the near term here, why does anybody care? Why would anybody, you know, like people will just go to somebody else who actually has it. And so your risk of losing some of your core user base, I think, is pretty high. So there's a lot of fear around that. I think, well, I'll put it this way. I would not be shocked, and I don't know if we have the data yet. Unlikely. And it's also, I wonder how we can try to find that. We could try to Google Trends the word Google, but who Googles Google is the problem, right? So you'd really have to, yeah, I don't know, from Google Trend, like, how do you get the Google Trends on Google Trends? But anyway, you know, you start getting a company like Google that realizes, oh wow, you know, we're tracking people in the Chrome browser and they're using ChatGPT more than they are using Google, and our growth is slowing at the fastest pace ever, or we're losing, you know, even a marginal sector. Just gonna throw more money into AI chips. That's it. That's just the way these cash-rich companies are just gonna deploy their capital. So it's totally not a reflection of what's going on in the market, or the economy rather. Like it is the near opposite of what's going on in the market, or the economy again. I always think of it as what, with the kid with the chair, or sorry, it's the kid on the swing, and then the fire in the background. Oh, you know what we should do? Y'all have seen that one before because it was so famous during COVID. Happy smiling kid. But anyway, what we should do is we should get like an AI version of that. That'd be kind of funny. Just to sort of like, you know, give us a 2024 version of the happy kid on the swing. Not that that really matters right now. But, heck, we'll do it anyway really quick. Here, hold on. Let's listen to that for a moment while I do it.
When I joined 13 months ago, Joe, we put a stake in the ground with the announcement and said we would do a transition in a year, and Neil would move to an exec chair. And that's exactly our plan of record and what we're going to do at the end of this month. And I will tell you, you know, a lot of people question the co-CEO thing and whether it can work or not, and I think it's gone incredibly well. In fact, I think we have a blueprint on how it should be done, and there's a number of reasons for that. I think, you know, Neil and I, we have a tremendous amount of respect for one another. We have a deep trust for one another. We have different skill sets. We come from different backgrounds. And I hope me joining him as co-CEO the last year has freed him up to go focus on what he's...
Yeah, so Bob here says AI chips, the next bubble to pop. Without the software, they're useless. Well, what do you think they're doing with the chips? I mean, the statement you made somewhat implies that they're just like buying the chips and putting them on a shelf. Like, no. They're trying to train LLMs. They're trying to integrate AI into new products and services. They have no idea what or where to be productive with these yet. It's a matter of trying to figure it out. But you have companies that realize, okay, we know we need to use these AI tools. And so then the question is, how do we implement them? How do we integrate them into the various different components of somebody's workflow throughout the day? And that's the competition now. The competition is, who's going to figure it out first? Is Salesforce going to be the most productive? Is it Google? Is it Microsoft? The stock market wants you to believe it's Microsoft. I don't know that Microsoft's going to be the best at AI. I don't even necessarily think so. I mean, obviously you've got server sets as well, but yeah, I mean that's the race right now. It's a software race of who's going to get the most profitable AI software first. That's one of the reasons I think Palantir is so interesting, because they were AI before AI basically. So I think they were AI when AI was still big data, right?
We're so broad in what we do. I do think last year we launched a number of key growth initiatives that will continue to push into the new year in February. Number one, we're focusing on our international growth. Today, we get 25% of our business outside the U.S., yet it represents more than 50% of our addressable market. So we're investing internationally. Yeah. We also are investing heavily in our financials platform. People obviously see us as a market leader when it comes to human capital management, but our financials platform is a major growth engine for us. In fact, we're seeing most customers start to think about, how do I deploy both at the same time? We call it a full platform sale. So we think that's another big growth driver. We've modified how we partner around the world. We leverage the ecosystem much more broadly to get operating leverage on the go-to-market side of our business. And lastly, I think the innovation engine at Workday is alive and well, and Neil helping, lead that.
All right, whatever. I think people go on these shows and it's just like it's just a giant sales pitch of their stock. It's like, we need a little bit of a pump. And, sometimes it used to work a lot. I don't know how much it still works. Workday hasn't done bad, though. I mean, let's take a peek here. Let's zoom out a little bit. It's almost back to where it was in November of 2021. Look at that. It's pretty wild. Almost back to November of 21. Let's look at their actual financials really quick. We'll just do like a super quick little glance at Workday, and we'll see how much money they actually make. Workday, Investor Relations. All right, let's see what we got. So let's look at some financials. Quarterlies. Yes. I want the SEC filings. I don't know, I always hate it when they give you the presentations and they kind of just point you to where you should be looking. It's like, let me go look myself. I don't want to see your guide. I want the form. All right, so how much money they got? So we got, what is this? 6.8 billies cash marketables. We've got, let's see, very little debt. We got about 3 billies here in debt. Unearned is essentially money they're going to earn, so I'm not so worried about that. Nominal miscellaneous expenditures here, so call it 4. So we've got free cash of probably around 3.5 billies of free cash. It's pretty good. Have to say, it's not bad. 1865, 1599, 16% revenue growth year over year in this sort of environment. Nice. How much money are they spending? Almost all of it. So how much money are you spending? Yes. Their advertising spend grew about 14%, so roughly in line with their revenue growth. But boy, you'd think they were a little bit more profitable than this. But they are now profitable. Net income 113 mil. A lot of this is going to end up being stock-based comp. So their free cash flow is probably great. And let's see here. Cash flows. Where are you operating? Oh yeah, there it is. 350 mil in stock-based comp in a quarter. Wow. That's 350 millies that in a quarter works out to about $4 million of stock-based comp per day. Wild. Oh, but it is a non-cash expense. Look at that. That brings them $450 million in operating activity. See, these are the companies that'll end up implementing, which I'm sure they already have, but they'll figure out how to implement even more of these AI integrations. And it's like, oh yeah, this is where you're going to make money. Workday with AI, Salesforce with AI, Microsoft Word with AI. It's going to be kind of wild. But while I have a hard time betting on the individual software companies, I think I hate to say it, but it's not horribly unreasonable that the chip sector is moving the way it is. Assuming that AI demand doesn't fade, and quite frankly, so far it's just strengthened rather than faded. Been pretty wild. So, tale of two economies. Exactly. Grok for productivity? No, I have not. Let's see here. Our graphics department, it doesn't even mark graphics anymore. They go to an AI generator website. Yeah, that makes sense. When will 90% of marketing departments be replaced by AI? Well, I wonder. Yeah, I mean, that's the wild thing is that, even ad creation now can be driven by AI. I mean, I know this is obvious, but this is where, like, Google, for example, is trying to incorporate AI directly into, and so is Facebook, into actually creating the ads. So it's kind of like, hey, you don't even have to come up with different ideas yesterday. You can just use our different, what's it called? Our different suggested, what's it called? Trying to say, what am I trying to get at? Oh, they'll make the ads for you basically. And you say, hey, like, which one of these do you want to use? We've already done some A/B testing for you, and we think all of these will work efficiently. It's kind of wild. Pretty wild. Please explain how rate cuts proportionately leads to market chopping. Well, I think it depends. I think you're in an environment where outsized rate cuts due to layoffs and unemployment would actually end up signaling a bottom for markets, a bottom after the bottom, so to speak, because I think most of the bottom has already been set in 2022, but rapid rate cuts would be the final bat signal to all the people with cash to say, this is it. This is time to dump into the stock market. And really what will happen is people with investments, wealthier people, will build a lot of wealth, I expect, in this next cycle as rates go a lot lower than we've ever seen before. Now, what is that going to mean for people who have credit card debt and BNPLs and low income or lower income? It's not going to be good. If you don't own real estate or stocks, I think there's a real chance of the wealth gap just substantially widening. So it's kind of a little bit of a broken system, but it's just what I expect. Interesting. 10-year just moved up another 2.5 basis points after the unemployment claims. You've got the 2-year up 2.2 as well. So both slightly moving up here. Interesting. U.S. Executives in Davos see Donald Trump as winning. Yeah, I mean, I think if there were an election today, it'd be pretty clear. Trump would probably win today, mostly because there's so much uncertainty geopolitically, economically, and that's just trying to look at it from an unbiased point of view. But a lot can happen between now and the election. You could literally have a recession, rates cut to zero, and the bailout progress and process. I don't know. All right, let's listen in here for a moment. Oh, he's still here.
He's right about some of China. I don't like what he did.
No, I said China virus.
Sorry, it's Jamie Dimon.
I don't like how he said things about Mexico. I don't like, but he wasn't wrong.
To clarify, he was there yesterday. I think they're just replaying this, but I'm not sure. Yeah, it was just a recap of it.
And that was JP Morgan CEO Jamie Dimon with us yesterday here in Davos. Former President Trump easily won the Iowa Republican caucus on Monday. And the political world's attention now shifts to New Hampshire with its primary next Tuesday and what appears to be a closer race between Trump and former South Carolina Governor Nikki Haley. Joining us, former House Speaker Paul Ryan.
Chaotic Pinky, what do you mean AI monitors that are basically Chiefs' game? How are the AI monitors helping out? I want to hear that. That's kind of interesting.
I don't know what they're called now, but whatever we do on Twitter, we put it out, and that's got about 4 million views now. That was just
the Jamie quote.
Yeah, and there's something
totally
in there
accurate.
for everyone.
Yeah.
There's something for Trump haters, Trump lovers.
No, Jamie's right about that. I mean, But by the way, all those positions are Republican positions, not just Donald Trump's positions.
True.
The things Jamie just articulated are Republican positions, and so that's the point.
That's the quandary, Paul. There are people that agree with Republican positions, but the flag bearer of the Republican Party right now, and the presumptive nominee is Donald.
Friend of mine says C3AI is an all-out scam. I mean, I thought that was obvious from like when they IPO'd. It was like their actual products just seemed ridiculous. Yeah, I mean, I agree with you. It's interesting to hear that. What do you think about advertising companies? Yeah, well, I'm a big fan of Trade Desk. It'll be interesting. They're on a bit of a downtrend right now, but it'll be quite interesting. Yeah, you got to be really careful, Mike. I see your comment here about multifamily. One of the things you have to be extremely careful of right now when it comes to multifamily real estate is that rents are falling. So you have to keep this in mind. As rents fall, your new turnovers in an apartment building rent lower. Okay, well, guess who's paying attention to those lower rents coming in? Everyone in the building. So what you do is you actually lower the rents for the entire building. So you have to be very careful with multifamily right now, because I personally think there are a lot of, frankly, owners who are trying to bail out of multifamily because they see this happening. They see the rent turnover. And the best time to try to lock in your cap rate is before you get the turnover. So you offer your incentives, or you offer your tenants some incentives to stay for, 6 more months. And then before you know it, the whole building turns, or you place some bad tenants and everybody gets pissed and leaves. Well, then you got to turn the building at a lower rent. And that's very difficult to do when you have a lot of new rental supply coming on. Like, there are what look like a lot of really good deals in multifamily right now. But then when you look closely and you re-underwrite them under what the rents should be, oof. There are a lot of pretty nasty, pretty nasty deals in terms of just the amount of supply coming on for multifamily rentals. So really pay attention to that. You be super careful with that, with specifically multifamily. So, okay, then what we have over here, we've got NVIDIA, 230 on the day, Carnival. Looks like everything's going to try to go green here. Let's look at, for a moment, let's just see what's moving in the largest sense. We've got TSM sitting at 7.5. DWAC bounces. I mean, they're up like 4 or 5% on the daily. ARM 2.5%. They've done very well. I've been very anti the dilution that's been coming for ARM, but so far they've been holding up, and they're positive post IPO. And maybe that's because the full dilution hasn't hit yet. You've got Adobe, Foot Locker turning down here. You've got Costco slightly red. Coinbase, well, that's basically flat. Yeah, there's not much red today. All right, so we got another 35-ish minutes or so to go. Let's find out what else we can get here. So let's go into finding what else there is out there. Let's go to my bookmarks really quick. There we go. All right, and then we're going to go to El Journal as well. So, yes. Right. Biden, I believe, I think it was 1:30. Let me look at the president's schedule. Biden speaks today. President's schedule. So today, President, daily briefing, Andrews Air Force, where is the briefing? There it is. Okay, Bidenomics speech. So let me mark this. Yeah. Okay. Bidenomics speech will take place at, first time, frankly, I've seen an address, like a full-on address in a while. This is supposed to be President Biden delivers remarks on Bidenomics and investing in America to rebuild infrastructure, lower costs, and support small businesses. So Biden speaks at That would be 11:15 a.m. PT on Bidenomics. Well, that'll be interesting. All right, what else? The $8.8 trillion cash pile that has bulls salivating. This is on the Wall Street Journal. Wall Street wants your money off the sidelines. Rising interest rates drew trillions of dollars into money market funds and other cash-like investments over the past 2 years. With more than $8.8 trillion parked in money funds and CDs as of the third quarter of 2023, investors are optimistic that rates are poised to fall and people will direct their money to the markets to fuel the next leg higher. Yeah, I don't actually think that's horribly wrong. Yeah. Yeah, like here's someone who, they quote this person who's a 37-year-old pharmacist in Indianapolis. And they're like, well, if I'm not earning at least 1.5% more than inflation, then I have to think about different strategies. And they're basically talking about, you know, right now he's earning more than inflation in, well, maybe like a 2% spread per his formula on, you know, time deposits like CDs, savings, money markets, or whatever. Boy, that's going to evaporate really fast. So, yeah, they've got a lot of different quotes here. It's hard to pass up CDs at 5.5%. Here's some 26-year-old. Just looks like a model. But anyway, it's like, come on. The opportunity cost in just money markets is pretty scary right now if rates are going to get cut aggressively. And I suppose it depends on what your outlook is. I mean, once you read 50 pages of the Fed Beige book, and you're like, and who put this together? The Fed? Okay. Interesting. All right. Let's listen in here for a couple comments. Let's see what they got.
Yeah, no.
Right. Why am I not?
But that's why I say there are lines, and you got to find that line. Jamie Dimon can do whatever he wants because he's Jamie Dimon. But your run-of-the-mill CEO who's 2, 3, 4 years into the tenure, they got to watch it because they're going to get sideways from their agenda, which is to grow their business.
That's why people are like Alex are so.
Alex, he's very
but he's cynical that they were willing to weigh in on safe woke issues.
That's my point.
And then when there's a real issue that they need to weigh in,
this is my point. I say
chicken jitsu. Sorry.
When it comes to like stupid culture war stuff, stay out of it. Do your business.
But they were perfectly.
But when it comes to really clear life,
and now they're nowhere to be seen.
Okay, but then I'm going to make it difficult, which is. And I think we all felt it. Remember, after George Floyd was murdered.
I was just reading another one of these comments, mostly because this on CNBC, I feel like, just sounds like a bunch of nonsense. Here's a management consultant living in Miami Beach, throwing 17% of his income into a high-yield savings account. It says, if rates fall below 3.5%, I would probably cut the money I'm putting in savings and instead put it into my investment brokerage or crypto. It's like, bro, by the time you do that, like, by the time rates are below 3.5%, you're going to be like, yeah, I wish I bought 2 years ago. Maybe I'm wrong. I don't know. Seems backwards, but okay. Okie dokie. It's interesting. They don't actually give much detail on the 8.5 trill. Well, 8.8 trill. I mean, it's mostly what you've got in money markets. All right, what else? So, Fed Bostic, what do you have to say? Bostic? Oh, the Atlanta Fed one. Really? Okay, well, Atlanta wasn't looking too hot, at least inside the Beige book. Let me see here. So, Atlanta. Wage pressures eased, hiring slowed for some firms, labor markets continued to cool, weaker demand for goods and services led to reduced hours, hiring demand, input costs down, insurance and labor still up, but many were offering discounts and promotions. There was optimism as manufacturing is slowing. That was Atlanta. I guess that's probably more one of the more neutral regions from the Beige book. But Bostic suggests that they don't want to cut interest rates, in his opinion, until Q3. That would run us by May, June, July. FOMC rate monitor. It'd be a luxury if they could make it that far. So yeah, you'd miss May, June, July, and well, I guess July would actually be. July's technically Q3. You start Q3 with July 1st. So by July 1st, let's see what the market's priced in by July 1st, just to compare. The market's looking at. Okay, what is this? All right, here we go. 11.5, 47.3. Oh, let me take that off. All right. 40.3 plus 0.8. Okay, so you have an 88.4% chance of at least one cut. Oh, that's by May. Let me go to the July one. Okay. Then you have 36.7, 3.1, 44.4. 84% chance that you've already had 3 rate cuts by July. And 98.8% chance that you've had 2 rate cuts by July 31st. So Bostic here is highly misaligned with the market, which I'm not saying he needs to be aligned with the market. But it's very interesting to see how far unaligned he is. All right, so let's take a peek at that. So let's see here. Okay, Mr. Bostic. Fed Bostic, and we'll write it down as well. Okay, so we have Fed Bostic. My outlook right now is for the first cut to be sometime in the 3rd quarter of this year. That was actually just now. That would probably be, that means he's giving a speech somewhere. I'm surprised I didn't see that come through over here. Let's see what we got. Oh, I see. That's why. There we go. All right. All right. Let's jump in here for a moment. See what the Jimbo crew says.
It does get a higher multiple in part because of the recurring nature of those revenues and the fact that, to your point, that they are very sticky, as opposed to coming out with a new phone and you never know how it's going to be met in the marketplace.
Right.
That said, multiple still gives some investors pause.
I'm not going to disagree with that. Our goal is not to sell any Apple ever, but it moved up a great deal. We were becoming the Apple fund, and I didn't like that. The Apple fund's fine if it's 20 times earnings, not if it's 29 times earnings. So I understand exactly what you say. That said, this is a roadmap, this Bank of America piece, that really defeats the defeatists, who basically say this cycle is bad. Now, I'm struggling with Vision Pro, by the way, because candidly, I was hoping, and Carl, we watch a lot of things on Netflix, and I was hoping so much to have Netflix Vision Pro.
Apple's been giving some demos. I got my shot at Vision Pro yesterday. Pretty fascinating.
Yes,
we're definitely in a new era, and you get a very Minority Report sense of moving these things around with your eyes. But yeah, the Netflix thing is a sign that not every developer is going to be on board in the beginning on Vision Pro.
In the beginning, and maybe that's a wait and see. Did you get to see any sports on it?
Yeah, there's some examples of you're above a goalie on a soccer field, or you're on the side of the third line baseline watching sports. Yeah.
Yes.
Can I ask a question? So you had the first demo of it.
Yeah.
You've had a demo of it too.
Yes.
Okay, just want to make sure.
This is payback for your doubts about Apple TV.
Apple. Thanks. I mean, isn't the best way to actually convert somebody to give them opportunity instead of not letting them use it?
I think they've come up with
I just not exist?
No, there's a special one they're developing for you, which all you get to do is watch the Mets.
They pay you to subscribe to that app.
That was mean.
Well, Jim, we'll couple the Apple call with Taiwan Semi. Double beat, gross margins beat. The Capex guide, maybe $32 billion this year.
That's very positive, and it's interesting because the nanometer they're talking about is Apple. They're saying handsets are strong. Now, again, that's very, let's say, counter to the prevailing wisdom. That's why the B of A upgrade comes out at the right time. Taiwan Semi, of course, we all know is where things are made because almost no one has foundries. So you're looking at Apple numbers, also AMD. And what I liked about the Taiwan Semi is the tone of it, as you mentioned with Capex, is that it's the PC cycle bottom. Watched Enrico Lores this morning from HP, and sometimes I want to say, Enrico, just say it. Just say, listen, this is it. He's more circumspect than that.
You mean about a bottom?
Yeah. I mean, I want him to back up my thesis.
Right.
Since my thesis is predicated on a lot of what I'm hoping he'll say one day.
Yeah. He's a bit more cautious.
Yes, he
than
is.
You'd like him to be.
Yes,
perhaps,
he is. He's a cautious fellow.
I guess he must feel the need to be. But that $32 billion Capex number from Taiwan Semi and the fact that they obviously do see demand increasing for the first time in a little while.
I know.
Given all the inventories that have now been worked through, stuff that was still left over from the pandemic, for example, is not unimportant.
It's amazing.
3 nanometer.
Well, I know. Wow. It's not, you can't see it's like a hair.
Yeah, it's microscopic.
I know.
It's incredible.
Let's remember that's good for Micron. But, you know, it's really great for Lam Research and for KLA and yes, even for AMAT, because they're saying, listen, we need to buy more machinery.
So I want to take a moment to mention a lot of folks are wondering, you know, how my thoughts evolve on inflation if insurance costs keep rising. And something that's so interesting about insurance is the substantial and lagging nature of insurance, because you know we were discussing this a little bit in the office yesterday. What's so wild about insurance is that you really have to, like, let's say you sign an insurance contract in January and your costs go up in August. You know, so you have you sign an insurance contract in January, then you have a lot of inflation immediately. Well, there's going to be a lag before your costs actually go up. Once you realize your costs have gone up, you're probably a year behind. And then you got to renegotiate for the next year cycle of insurance, which will take another full year to fully actually lap and show results in. So insurance, I think, it is something very interesting that in the Beige book, which I linked it here on ehack.com. If you jump down over here, I also threw the Atlanta Fed real GDP now indicator, which I'm blown away by this, that it's actually 2.4%. But anyway, you pull the Beige book in here, and when you go through this, and my one of my interesting or my favorite ones was the egg one over here. Look at this: less exodus of private work or public workers to the private sector. High food prices had essentially led people to start raising chickens and ducks, and I'm seeing more self-serve egg stands along the road. And what you find is there's a lot of optimism in this report. I'll end up writing a full summary, probably make a video on it, but it's just going to take me a little bit to get through all the 55 pages. But anyway, yeah, it's when you start looking at this, you go, wow, and the leftover inflation pressures is insurance. But then you think about it logically, and it's like, well, duh. Of course one of the last inflation pressures is insurance. Of course there's going to be a lag in that coming through. So I think that's very interesting. So then you've got Morgan Stanley. Let's see here. Oh, what is this? Morgan Stanley talking about the Fed being prudent with their rate cuts, and then more mergers and acquisitions will pick up. That's boring. The Red Sea crisis worsens. We did hear that. Third commodity carrier in 3 days now. It's just nuts to think that we're in the region and we're at the third strike in 3 days. It's like we got there and it got worse.
I look at Discovery, and if this were 2008, you'd think that they're like Discovery is like, look out. I mean David, the losses here, the charge-offs are
net charge-offs.
Yeah, and they
4.11%.
That's insane. That's terrible.
It's 198 basis points. That's almost 2% higher.
So who are they letting have a
year.
credit card? I mean, I remember when I had 8 credit cards when I got out of law school, and Banco Popular was the straw that broke the camel's back. I said, I got to start paying some of these.
Credit card net charge-off rate was 4.68%.
But that's incredibly poor standard.
And again, this is why the stock is down, up 231 basis points from the prior year.
Well, that's just
and 65 basis points over the quarter increase in delinquency.
I thought it was astounding. If you're someone like Jamie Bitcoin Diamond, I think what you would say is, wow, those guys are really a bunch of I don't think he's going to call them clowns because he's a little more diplomatic. It's a bunch of bleep.
Meanwhile, the carnage at Humana, and from a stock perspective, is far worse, I believe. It's been down as much as 11% in the pre-market. We can take a look. Yeah, there it is, over 13%.
No, we made a lot of money in Humana, and we kept a little back. And, of course, we shouldn't have kept a little back, but it was really a home run. What happened here is the Medical Advantage plan, they got it wrong. They raised, I'm trying to get exactly what my Medical Advantage, here it is. I pay $172 a month for the supplement, and that's a bargain, given how much you have to.
It was kind of two different things, although one they may be happy about. One was they came in below in terms of adding members.
Right.
For
they raised because they raised
Medicare
the price.
Advantage. But they may be happy because they seem to be losing more money on those members, so they're going to have fewer new members to lose money on in the near term.
Well, they're going to make that up in volume.
Because of the medical cost.
They're revealed. Okay, so David, come on, let's go there. Let's go there, David. I'm going to go there.
Wait, where are you going?
I want to go there.
Where are you going?
Okay, this is just so Jeopardy-like. You know who else was good in? Never mind. Okay, Humana.
Yes.
The moment you knew that there was a discussion between Humana and Cigna,
yes,
that was the Hail Mary pass, not unlike what Dan Schulman did at PayPal with Pinterest. It was a desperate act of a company that was truly in trouble. Cigna announced a buyback after these talks. Humana
after
was
its
silent.
shareholders revolted and said, "Don't you dare do that."
Yeah.
David Cordani, I think, still may have wanted to, but backed off.
Right.
Did back off, and Cigna did institute, as you say, the
And they
buyback,
bought
as
the
opposed to
buyback.
doing a deal that, again, as I'd reported, a number of large shareholders were saying, please, no. They couldn't understand
It was
particularly the
ill-advised.
multiple disparity between the two.
But that showed you that
given
Humana
Cigna's
was in
multiple
trouble.
far
You
lower.
should have realized. And
You think so?
Oh.
All right, they're killing me. It's so boring. So, okay, let's get out of there. Okay, so... let's see here. What do we know? So... When was really... Let's see, the bottom in the stock market in 09 was like March when the Fed came in for a bailout. March 09. And then we had like... No, it was February 09. And then you had March of 2003. Very interesting. Something that is also very interesting is how rapidly unemployment claims rise. This is my anticipation. This is actually my greater fear, if you will. So if you go to unemployment claims and we look at a history here in terms of how quickly claims can rise. I mean, you're going to have to adjust this chart because you have to get rid of COVID. Otherwise, well, when everybody files for unemployment in the same week, you're going to have a little bit of a weird chart here. So let's kill COVID for a moment. And let's just zoom into some of these just briefly here. Look at the rapid incline you have. I mean, you had this slight increasing trend, but once you got to July of 2008, I mean, it was rapid. I mean, you had 20% increases here in these numbers in in a span of 2 or 3 months, and then in the span of 6 months, you essentially doubled. Yeah. So I think these claims can come pretty rapidly, but let's let history do the talking. So they were not too rapid over here in the .com. Definitely did get some spikes. So what do we have here? Yeah, a little more on the rapid side in the 90s. You're going from about 362 up to 450. It's surprising it doesn't actually require that many more weekly, because remember, these are weekly numbers. These are a lot of people when you consider these are weekly numbers, right? So every data point on here is a week. So you take that number and you go up even 50%. You were essentially, in a recession here, because you go from 300 to 360. That's not a lot. That's a 20% increase and you were in recession. Let's see what we have over here. This is 332. Yeah, same thing, 20 to 40. I mean, up its peak a lot more, but you were already in the recession. Well, let's measure from the bottom for a moment. Measure from the bottom. Bottom was about 300. Yeah, by the time you were 20% in, you were only at this section here. You were already in a recession. Okay, so then we have the 82 and 81 recession. I mean, that was rapid. Look how quickly that happened in 80. 418,000 to 642 weekly claims in the span of 2 months. Holy smokes. See, that's what you want to be afraid of. That's very interesting. That's not in every recession. I will say that's not in every recession. But that's definitely one you want to watch for. Oh yeah, here's another one. Look how rapidly this increase occurred over here, 74, 75. Take a picture of that. We saw the 80, 82 was a little more gradual. I mean, you could say 91 was somewhat rapid. 2008 certainly accelerated much more quickly. How are we doing on the edge right now? So I get rid of COVID. Yeah, you're so low right now. That's wild. Wild. You don't have... I wonder if I can moving average this. But it's very difficult. Yeah, the weekly... Let me go to monthly. This will smooth it out. It's pretty good right now. Quarterly. Yeah. No, I'll stick with the monthly. It's pretty good at the moment. But again, I wonder how much of a lagging indicator it is, and I think the answer is substantial. So yeah, you go monthly on this. Boy, when you look at the monthly numbers, you could really see in almost every recession how rapidly it moves. Wait a sec. Yeah, there's 70, rapid move up. 81, rapid move up. I'd say that's relatively rapid. I mean, you double... You grew your claims by about 40% in the span of August to December, 4 months. Good chunk over there in 4 months. 91. July to election. Big move. Oops. Yeah, that's going to be something to watch, is the potential, how quickly these unemployment claims can really flip once the jobless recession begins. And once it begins, the claims didn't stop once it began until the recession was over. In fact, claims coming down again marked the bottom or the end of the recession. I love how Kevin is just now realizing job data lags the recession. Do you realize I've been literally saying that for over 2 years and that we have to be careful of that? We're not analyzing that it lags. Like, welcome to what we've talked about for 2 years on the channel. Thank you for finally catching up and then trying to pretend that I'm not aware of that. What I'm discussing and trying to reveal is the rapid acceleration of jobless claims. How quickly it evolves. That's what matters. Because I think folks think that you slowly... Bro, are you blind? Did you not watch the big drama that we had in January and February and March of 2022 when there was another YouTuber? I mean, this was like a big, like, famous moment where another YouTuber is like, unemployment claims joblessness doesn't lag. And I'm like, what are you talking about? It's the most lagging indicator you could have. There's like a big drama fight about it. Like, it's like scarred in my memory about how long we've been talking about this lagging. This is a freaking moron. But whatever. The point is, what matters here, what matters for everybody here, is that what's remarkable is how rapid this changes. And so when we look at that monthly level, the weekly, it shows it probably takes about 3 months. But what's interesting is if you apply that 3-month logic, let's confirm that for a moment. So let's look here. Let's go. So from here, we go from 205 in November of 69 to, I'm looking for up about 20 to 30%. So we go up 20%, which we have not seen. I don't think we've seen 20% in quite a while. Let's see what I can get here. I'm going to pull the current stats. And let me look at, I want to look at just the latest. I mean, I guess I could just do that on here too. But anyway, 20% happened in a 20% increase occurred in 2 months. 2 months to get a 20% increase. Here you had a 20% increase in 2 months as well. That's about a 30% increase in 2 months. 2 months is all you need. Yeah, I mean, that's 1 month. No. Well, I guess it depends where you measure from. It could have been as quickly as a month. 1 to 2 months, and you could get a 20% increase in claims. And the market does not actually, or the recession, look at how perfectly the end of recession matches with unemployment claims. So unemployment claims right here, almost perfectly. I mean, here you had a little bit of a double top, but almost perfectly matching. Let's zoom into or the other recessions. Yeah, look at that. How cool. So I think there are two really interesting takeaways from this. It's not that unemployment is lagging. It's old news. It's that unemployment claims don't actually top until basically when the recession is declared over. So that was true in 82. It was true in 81. That was true in 75. It was true in 71, although you had a little bit of a double top there. It was true in 91. It was true. I mean, this is a perfect indicator of the end of recession, is when unemployment claims top off. And the other conclusion is that you could get a rapid deterioration, which I think is going to happen. The deterioration claims can deteriorate by 20% in the span of 1 to 2 months. Okay, so we've got that. And what else? Let's go back for a moment and then just see how bad it could get in the span of a quarter. So I can go to quarterly for a moment, and that really smooths this out. So look at quarterly for a moment. This is a 1 quarter change. So if I go from, even from the bottom over here, what do you got? Like 239, 249. No, these are kind of nominal. That's all 10,000 difference, but that's not in recession. You're really in recession over here. 1 quarter, that's a 10% change here. 10% change turns into a 100,000, 30%. 10 to 30% in a quarter. 422 to 586. 586, 422. That's a 38% decline or delta. That's 451, 516, 516 divided by 451. That's 14%. And over here, that's, what is that? I mean, at worst, you were probably somewhere around 20% here. 20% per quarter seems to be about the worst. Wait, but did we have a 30% over here? But roughly about 20 to 30% seems to be about the worst per quarter. But that's pretty bad. Honestly, once you started getting 10% of an increase per quarter, I think you were walking into a recession. Because here's your, but that's not true in your soft landing in the mid-90s. Wasn't true over here. So 10% isn't going to cut it. 10% is not enough of a threshold. Unemployment claims need to go up 20%. I don't think there's a single instance where you went up 20% and you didn't have a recession. Let me see if that's true. So here we went from a low of 360 on the quarterly to 404. That's not 20%. Here you went up, 345. That was close. 402. 402. 345. Yeah, it's 16%. Nope. 328 to 379. 379. We're going to be able to apply these numbers to our numbers today. That was 15%. Once you got above 17%, honestly, you got a problem. Okay, so now here's the crazy thing. So now what we're going to do is we'll apply that weekly to what we have over here, post-COVID. There we go. Okay. Now, was it true over here? Oh, let's see. Ooh, you could say top to bottom over here was more than 20%. How weird. Look at that. Oh, is this time different? The dangerous words. 182 to 164. 264 rather. 264 divided by 182. Ooh, that's a 45% increase. That should indicate recession already. But has it ever in history gone down like that? Before? Oh, how dirty. Dirty to screw up our data like that. But it is the data, so you should respect it. Not really. Once it starts rising, it starts rising. Yeah, you don't really get a decline. I mean, with the exception of 85 over here, but you didn't have that big of a spike. Unless you're just coming off that much of a low. Oh, but this is a quarterly figure. So maybe, we were doing the numbers off quarterly. Okay, so quarterly bottom 207 to 222. What's that? Ah, okay. 222. That's only 7% when you look on the quarterly. So maybe looking at the weekly is not the way to do it. So that might be more true than in the weeklies. Go to a prior recession here. Oh, yeah, you can't do the weeklies because you get too many spikes. You can't. Okay, so scratch that. We're not going to do the weeklies. We're only going to do the quarterly. And the quarterly was once we were up, over 17%, we had a recession, right? And so far, it looks like our quarterlies at max went from 206 to 240. 240 divided by 206. That's 16.7%, 16.5%. It's interesting. It's close. So I think the safest way to go with this, and we got the bell coming up here shortly. I think the safest way to go with this is 20%. Throw this up in here. Claims can deteriorate by more than 20% in the span of 1 to 2 months. And historically, if claims are up 20% on the quarter, 20% or more on the quarter, we had a recession. So that basically says the economy could shift pretty quickly in like a Q1, Q2 or something like that very, very rapidly if we do end up getting waves of joblessness. What I was reading in the Beige book yesterday, which was so interesting, was this idea that companies are like, they're hopeful that demand is going to get better in Q1, but they're almost tempted to start laying off. And that was really interesting, that they're holding on because they have leftover optimism. Which, remember, when you look at the Atlanta Fed real GDP now indicator, you're actually sitting at 2.4%, but these are Q4 estimates. Q4. These are not Q1 estimates yet. Let's see what we got over here.
Brought some of the things that you said. Maybe you have the white paper to the board itself. The board does have some very serious people on it. Were they not given or apprised of some of the ideas that you have?
Tim, they have a lot of substantive people on the board. But let me give you this fact. The entire board, including Bob, own less than $15 million worth of stock each. That's not a hell of a lot of commitment to this company, given the fees, etc., that they get from being a director or an officer of this company. And when you want to talk about Bob has taken $1 billion out of this company since he's been there. $1 billion. Okay?
But do you think he's overpaid? Most recently, he does stop.
I got to finish this statement. Last year, he got paid $31.5 million. Okay, earnings were down. They missed everything. The stock was down. Everything went bad, and he got $31.5 million. You know, I don't understand what this board is doing. I don't know what they're there for other than friends of Bob. You know, that's what this is all about. It's just friends of Bob. It's a hand-picked group of directors who are not doing their job.
Here's the bell. We got that squeezed in here, Nelson. We're going to keep you around for a second.
I lost you guys.
Well, I did just want to point out the the board didn't get hurt as badly as I thought.
It's kind of weird. I've never seen them do an interview through the bell before. And the guy's like, what's all this loud ringing? What is this ringing in my ears? Oh my gosh. All right, so we've got Q's up about 1%. Tesla doesn't know what it wants to do. It looks like it wants to go down. Workday, after their CNBC pitch, boy, they don't get a lot of volume, up about 1%. Enphase got 1%. Intel 2% on that TSM move at 8.7 with that. I mean, these are Microsoft-like level margins. Really impressive. Trade Desk up 2%. Coin goes positive. Nvidia is up 2. Cloudflare's up 2. Costco's down. Good. Zim's up. And let's see here. What else? Let's see some of the big movers. But yeah, that's I do think that's those are some interesting insights on let's see, Etsy up 2.4 maybe after those retail sales numbers yesterday. Huh? Interesting. And then Rivian, okay, Bitcoin 42.5, kind of stuck over there. All right, so let's watch the Qs and see what other news there is. But that. I want to. The whole point, by the way, of that unemployment claims exercise is Nick T talking pricing power. That's funny. The whole unemployment claims exercise is really a way to show you have a real risk of feeling comfort in unemployment claims data. So, what do we have here? Nick T. Was it all just supply that caused inflation? Chris Waller's not having it. Well, from a simple macro point of view, if you're going to increase the spending in debt by $6 trillion in a matter of 2 years, and then say that has no effect on demand, it just seems impossible to me, of course. It isn't the only thing that contributed to inflation, but it had an impact, of course. The reason I say is people have been talking a lot about, the last 6 months show this was all supply, supply, supply. Well, if these are temporary supply shocks, when they unwind, price level should go back down to where it was. It's not. Go to Fed, pull up a CPI, take the log, look at that thing. The price level is permanently higher. Well, yes, that doesn't happen with supply shocks. That's an interesting argument. The idea that supply shocks don't lead prices to permanently move up. I don't know if that is that. Yeah, I would agree with that. That it's a combination of obviously the supply chain issues, but then obviously also the printing. I mean, there's no question of that. The printing essentially diluted the value of all of our money by giving everybody more of it, and so of course the level is going to be higher. But Max, you were saying Nick T had some replies. Okay, let's see what his replies are here. Replies. Right, let's see here. How interesting. Actually, all you need to do is listen to CEOs on their earnings calls repeatedly say we have pricing power and we're using it to keep raising prices. Okay, that's what somebody wrote about General Mills. You got to look like, I don't know if you're looking at recent earnings calls or old earnings calls, but Nick T, that's interesting, replies to that. Right, but they did not have pricing power because demand was strong. But did they not have pricing power because demand was strong? We have pricing power isn't something businesses say when demand is weak. Yeah, okay, so it's interesting. It's a demand argument. Well, my take is that every company thought they had pricing power in, during COVID because everybody had money to spend money on everything. I think most of that pricing power is what I like to call faux pricing power, fake PP. Nobody likes fake PP. Weak, fake, soft PP. Nobody wants that. And so really when you look at most company earnings calls now, this impression that prices can keep being raised is heavily lost. And instead, now the focus is profitability and, trying to squeeze margin out, layoffs, right-sizing employment. If we do end up, which I hope not, because I think it'll cause a lot of pain, But if we do end up getting a layoff cycle and unemployment claims jump rapidly, it will drive rate cuts pretty rapidly, is my expectation. Much faster than is being talked about now. So we shall see, I suppose. We shall see. Let's see here. Let's see here. If you look at category, so this is, I just decided to pull up General Mills just to see what General Mills says really quick, given that this person on Twitter implies that they just read the General Mills earnings call. And they say, you look at category pricing and it's somewhere in the 2 to 3% range. So we continue to see inflation at a lower level. Pricing trends tend to follow inflation. Exactly. 2 to 3% for General Mills. And what you're finding a lot of is companies are like, oh yeah, we think inflation is going to be 2 to 3%. And then they're like, oh, JK, it was like 1 to 2%. It was even lower. Let's see here. Our pricing trailed inflation. Okay, yeah, that's a sign of pricing power. Not. General Mills pricing trailed inflation. This is a problem. Some rando on Twitter. Oh, well, General Mills says they have pricing power. Just read their earnings calls. Really? I'm looking at their last earnings call, and it appears to me they're saying exactly the opposite. I'm not going to get into the specifics of future pricing. Yeah, that's usually when you're not seeing much. We see inflation in the low single digits. Exactly. And again, that doesn't mean prices down. It just means prices up very slowly. Look at our expectations on pricing, sequentially stepping down as we lap pricing increases from the prior years. What else? Yeah, so like, you know, going back to what this person says on Twitter, actually, all you need to do is listen to the CEOs on their earnings calls repeatedly say we have pricing power. General Mills, implying they have pricing power, but then you actually look at the earnings calls here, and that's exactly the opposite of what we have. So the day I heard CEO of General Mills say it, I stopped buying anything they made. Well, read a new earnings calls. It looks like they're stuck in last year. That would make sense. Everybody was bragging about pricing power last year. That makes a lot more sense. But you can't use an earnings call you read last year in an argument this year. This doesn't work. There's literally an earnings call out from December 20th, less than a month ago. So people need to wake up. Oh yeah, Tesla did lose the lead.
Lost the lead.
And so did Enphase. That's okay. So what else do we have? We have TSM holds up. We've got CBO volatility up. Rivian's down another 3. And I wonder if we're still unpricing some cuts. Let's see here. Let's see. We have Fed rate monitor for March. Yeah, once you get the tick up in claims, I think it's probably too late. But we're only sitting at a 57.8% chance right now of a March cut. CEO's job to say they have pricing power. Yeah, so imagine when they don't say it, because they didn't say it in the last General Mills call. Appreciated the review of Coinbase versus SEC. Yeah, that was fun. Yeah, I really enjoyed that. Everyone's talking pricing power. Yes. What do you think about mall REITs looking forward? I'll tell you what I think about mall REITs. I'll tell you exactly what I think. I think anybody selling any kind of product, frankly, to anybody in the bottom 50% of income is going to see their stocks get screwed. Nike, mall REITs, Macy's, whatever, Costco, doesn't matter. Anything appealing to that bottom 50% gets screwed as soon as we start getting layoffs. And the Fed bailout will be too slow. So I'm staying away from anything possible. Like, I'd rather invest in China than invest in anything that's affected or exposed to bottom 50% getting whacked. Because I think it's going to happen. And the bottom 50% getting whacked is what is going to wake the Fed up to realizing, oh, we actually have a deflation problem. Oh no, cut to zero. Oh no, we can't get it up again. Like, it's literally, people are going to be so indebted coming out of the cycle that you're not even going to be able to get inflation up again. You'll cut to zero, and we'll be like, well, boys and girls, we have achieved 1.7% inflation. Well, I suppose on a flexible average basis, we had 2%. It's going to be crazy. No. People are like, oh, Costco, people got to eat, don't you think? That's not how Costco works, man. You gotta, everything is about marginal analysis, marginal growth. What happens when people cut back? You want to hear people got to eat? Let me respond to people got to eat with the most simple. This is why I read every day, okay? I will show you a response to people got to eat, and I think it'll blow your mind. Okay, so because people don't think this is possible. Where is it? It is stand by. This is a good one. It's worth it. Worth waiting for. Pull up my book. Okay, it was at the bottom. I read this sucker for like 2 hours yesterday. I was also getting distracted because it's very dry. Okay, where is it? It's not in that sector. It was right here. Where? Damn it. Where is it? Okay. Let me try to Command F. Hold on. Give me a second. You will be blown away, I swear. But while I found it, the point is, there, got it. Okay, here it is. I found the section. Okay, now I just want to show their words of it because I put my summary of it. It's in this section. Okay. 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 It's in this section. Let me just show it, throw it up on screen here. Okay, ready? So, Kansas City Fed, Beige book. Oh, there it is. Contacts, I should have highlighted it. That's why I couldn't find it. Contacts noted sales volumes at low-cost, quick-serve restaurants, which had been robust despite pullbacks elsewhere, declined moderately. So even cheap food and quick-serve food started getting whacked in the Kansas district as consumer spending fell. I mean, this was the worst, one of the worst ones. Fast food pulled back, consumer spending pulled back, labor demand weakened, seasonal labor demand subdued, loan demand down, notable reduction in labor utilization and hours worked, weak orders, slowing production, consumer spending and discretionary saw substantial declines. This was like one of the worst sectors. And so when you look at this, you go, wait a minute. But people got to eat. Let's go back to your statement, right? Your statement is, but Kevin, people got to eat. No, they don't. Like, now this is going to sound like, I know that sounds delusional, but what happens is people go hungry. It's effed up. They have to eat, but they can eat less. And I'm not here to say that's okay. That's bad. That means we need more charity. It means we need more food assistance. It means we need more help for people. But it's so bad. It's getting so bad at the lower incomes that the demand at charities is going straight up and the people need to eat is going down. And so revenues go down. Or you buy the cheapest stuff you possibly can. Or you go to Costco and you stop buying all the other stuff. You don't buy the stuff in the center aisles anymore, like the books and the toys and the clothing and the jeans and all that crap, so you can't afford it anymore. You don't buy the nuts and the fruits anymore, and you start eating the packaged cancer-causing food instead. So, like, it's a shit show. It's horrible. It's a really bad thing when the bottom 50% gets whacked. And that Beige book says it's getting closer. That's all I gotta say. That Beige book says it's getting closer. It's scary. So, anyway. It applies to everything. I mean, like I say, I don't know if these stocks are going to go up or down, like all of the different ones. I'm just not putting my money in anything that's exposed to that sector. Yep. Beans and potatoes, rice and beans, basically. Yep. No, it's sad. But we'll see. So yeah, the free samples at Costco are always pretty good. How will we know when the recession is over? Money printer doesn't solve unemployment, right? Does unemployment naturally go up? That's interesting. I mean, quite frankly, we saw that in the claims data, right? Like, it's interesting because just today we're looking at unemployment claims, and the unemployment claims tell us when it's over. But you know, right now, I think we've got to realize that it's either getting close or it's about to start. So yeah, I'm not very enthused about avoiding a recession, but I'm bullish for what it means for rich people stocks. So I think, you know, well, chips probably just continue to do very well. But then you look at the other, you know, discretionary purchases that wealthier people can make, those probably do very well as the economy sort of recovers and interest rates come down. But everybody else gets screwed. It's just going to suck. So that's why I'm hopeful that the Fed could try to prevent that. But I don't know, man. You get people like Bostic. I don't even think he reads his own Beige book. That's kind of sad. So... yeah. Okay. So anyway, I think it's time. I think it's time to run, so let's press the button. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. Yes. Well, there you go. We're going to jump on over to the course member live now. I got to post the link. Thanks for being here, folks. I'll post more updates on eHack, including my full Beige book summary. And hope to get some more stuff over there today. And we'll see you soon.